Good morning, and welcome to today's webcast, Cash Refunds for Green Energy Projects. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Craig Lammlin, Director, and Ben Alderton, Senior Manager. Craig has practiced public accounting since 2001, specializing in state and local tax. He provides advisory income and franchise tax services to clients in a variety of industries, including technology, manufacturing, and telecommunication and media clients. Ben has worked in the tax credit industry since 2012. He advises clients on new markets, tax credit financing, as well as other tax credit opportunities, including transferability, elective pay, and bonus credits brought about by the Inflation Reduction Act. And with that, we have our first polling question of the day, which I will get into here. Is your organization considering a green energy project in the next 1 to 3 years? A, yes, B, no, or C, I'm not sure. So if you select the from the answers here and hit the submit button, we can record your polling question. And with that, I'll turn it over to Craig.
Thanks, Chad. I appreciate that. And I apologize. I'm not okay, there we go. Let's get the big slides up. Would you be able to share the big slide? I apologize. I've got little ones.
Yeah, I'm leaving this one up so they can answer the question in there for a sec, and then you can kind of dive right into it. We got already about 90% of attendees here, so I'll give about 10 more seconds to answer, and then we can just advance on to the results slide. All right, here we go.
Okay. Yeah, I apologize. I can't see the slide to present.
If you just, so I can run through the results here. Okay. So 39% said yes, 21% said no, and 38.4% said I'm not sure.
Yeah, I apologize to everyone. I can't see the slides. I can only see Ben and myself. And there they are. I apologize. Here we go. Great. Sorry about that. So normally when you join a presentation around the Inflation Reduction Act, everybody is able to kick it off and talk about this is a massive historic investment in green energy. Unfortunately, I wasn't able to see the slides, so I wasn't able to share that with you up front. But now that I can see the slides, that's correct. When the initial budget scoring of this came out, Congress thought that this would be about $370 billion in incentives for green energy projects. As it turns out, over the last year or so, when other financial institutions, banks have looked at this and reviewed it, it's more realistic to consider that there's probably between $1 to $2 trillion in potential incentives over a 10-year period for businesses and industries that are going to invest in this particular space. What's really interesting about this, however, and what makes this audience very unique compared to other presentations, is before the Inflation Reduction Act, before the advent of elective pay, which we refer to from an industry perspective as direct pay, there really was not a way for tax exempt entities to monetize these types of benefits because, just very directly, you didn't pay tax. So credits were not something that were necessarily of value to this type of audience. But because the IRA allows for tax exempt entities, and we'll talk a little bit about the definition of that, to essentially generate these credits, and rather than use them to offset tax, but actually just receive a check in the value of the credit, it's a very unique proposition that allows for us to be able to have a webcast like this and talk to you about what is available. And the specific code section that we're talking about under the under the Internal Revenue Code is 6417. And as I had sort of alluded to before, within the code, it's referred to as elective pay. But if you were to go to your computer and type that in, more frequently than not, you're going to see people referring to it as direct pay, because it's essentially a direct payment from the government in the amount of the credit to your organization. Now, not everybody receives this. You have to be what's considered an applicable entity. And we're going to talk about what an applicable entity is, why you're here, and why this is so valuable to you. It's important to note as well, this is not a grant program. For virtually all of these benefits, but for a handful, there's no application. You receive this as of right. And what I mean by that is if you simply do what you're supposed to do, you place qualified property in service, you simply are able to receive this benefit when you claim it on a tax return. And we'll talk about that for entities that previously did not have to file tax returns and what that looks like. So we'll move on to the next slide. All right, so applicable entities, what are they? So we've got a variety of different types of entities that Congress decided should be eligible for direct pay. Tax exempt entities, states or political subdivisions. So think about state and local governments, municipalities, and then think about all the different types of organizations that are attached to that and are viewed as instrumentalities of governments. They specifically called out the TVA, the Tennessee Valley Authority, for any tribal clients or tribes that are on this webcast. This is a very different type of credit and incentive opportunity for you compared to what you may have been familiar with in the past when you have to fill out a competitive grant application. Same thing for Alaska Native corporations. Then we have a whole bunch of rural co-ops that will also be able to qualify if they're producing electricity for persons that are located in rural areas. And then lastly, as an aside to all of this, in addition to the types of entity that qualifies for direct pay, under the legislation, Congress called out 3 specific types of credits that are eligible for any type of taxpayer who engages in them. So you have Section 45V, which is clean hydrogen fuel. There's been a lot of discussion about clean hydrogen fuel so far. We have not seen many projects in this particular space. You have Section 45Q, which is carbon sequestration or carbon capture. These are high cost, capital intensive projects, but are unique because of the incredible dollar value that Congress placed on carbon capture. And then lastly, under 45X, advanced manufacturing plants are eligible to receive direct pay. And it doesn't matter what type of taxpayer you are, simply by engaging in those three activities, and you can pick any one of them individually, you would be eligible for direct pay for the first 5 years of the project. And then ultimately, if you as the taxpayer were engaged in one of those three projects for more than those 5 years, and in all likelihood you would be, in the back 5 years of the project, you would either want to utilize that credit on your return, or alternatively, the credit would be eligible to transfer to a third-party taxpayer who would be eligible to use the credit. But ultimately speaking, the credits that we're going to be talking about today relate to what we'll call applicable entities, your tax-exempt entities, your state and local government, your tribal businesses, and then ultimately tax-exempt for healthcare type clients. So those are the ones that we're going to be focused on today. All right. So when we talk about these types of programs, there's really two types. There's something called an ITC and a PTC. And when we say ITC or PTC, it's short for either an investment tax credit or a production tax credit. And they sort of fit into two different types of buckets, except for a handful of credits that we'll talk about at the end of the presentation. Investment tax credits and production tax credits have been around for a while. It is really the fact that the IRA has tremendously increased the potential value through the percentage of credit eligibility for them that we're really talking about them right now. An investment tax credit is a one-time credit which is based on the cost of the qualified property that is placed in service. So, typically when you think about this, you're talking about solar panels, a biomass facility, think wind turbines, things of that nature. And what you're doing is you're placing that property in service, and then based off of that, you put it in service, say at some point during calendar 2023. Based off of what you do around that project, you would receive a credit percentage. Now, that depends on a variety of factors. Ben is going to talk about what some of those specifics are, but you go from the low end of 6% of the credit potentially all the way up to 70% of the value. So if you think of your typical $100 project, think about it either a 6%, 30%, 40%, 50%, and then there's an opportunity to jump up to 70%. The credit is available one time for the year in which it's placed in service. And an important consideration related to an investment tax credit is it has a 5-year recapture period, meaning for 5 years after the property is placed in service, if something were to happen to that project, say for instance there was a natural disaster and it was to be damaged, you would presumably have to reduce the amount of the credit proportionately to the number of years that remain out of the 5 years. The second type of credit that we're talking about, the PTC, is a production tax credit. So this is a credit that is based on the production and sale of a manufactured product, such as electricity or renewable energy equipment. That's what you would be seeing in Section 45X, to an unrelated third party. That's an important consideration when we think about how we structure production tax credits and we sell what they produce to other individuals that may or may not be related with the entity that's doing the production of the credit. So for instance, for tribes that may put it in an energy production facility, They want to consider who are they selling the energy to. If it's to other related members, you may run afoul of the production tax credit rules. So it's important that you think that through to ensure you're actually selling to an unrelated third party. The production tax credit, unlike the investment tax credit, which is earned in 1 year, is earned every year for 10 years while you're producing that particular item. So conceivably, you have a significantly longer period of time to generate a credit over, because it's 10 years compared to 1. That doesn't necessarily mean that each year you're generating as much credit as you would have just in that 1 year for the ITC. So it's important when you consider the property that you're placing in service, what are the relative values? What's your time horizon as you generate the credit amounts? One of the advantages to a production tax credit, however, is this. Once you produce the item, whether that's electricity or it's a renewable energy piece of equipment that goes into a solar panel, for example, you've produced it. So there's no recapture consideration. So depending upon what your time horizon may be, depending upon what your cash needs may be, there may be a benefit to either pursuing the investment tax credit or alternatively looking at it from a longer term perspective and considering doing a production tax credit. So from a direct pay provision, this is sort of the full menu of all of the different types of credits that are available to applicable entities and other taxpayers under the Inflation Reduction Act. We are going to be talking about Section 30C towards the back of this presentation for alternative fuel vehicle refueling opportunities. That's one where if you're going to be putting in electric car chargers or other technology for EV equipment, Congress is really focused on enhancing that benefit. There are a number of strategies to consider around that. And it's something that we think a lot of taxpayers are going to be doing because that's directionally where a lot of businesses and industry are headed from an EV perspective. And as a result of that, we want to make sure that as clients are doing that, they're aligning with the provisions in the IRA to make sure they're qualifying for that. As we talked about as well, there's the production tax credit. 45Q along with 45V. Those are two of the three credits that are available for all taxpayers, 45X being the other one, the advanced manufacturing, that are available to all taxpayers for direct pay. But for applicable entities, you can sort of see the full menu of what's out there. But again, they fall into the bucket of either a production tax credit under Section 45 or a Section 48 credit, which is an investment tax credit. This is a handy chart because, as Ben is going to get into, there are a number of enhancements for these credits that will allow you to go from that initial 6%, which if all of these credits were 6%, quite honestly, we probably wouldn't be talking about them. But because of the increase based off of enhancements, which he's going to get into in greater depth, that's how you're able to get to your 30, 40, 50, 70% of value. And then whether or not they're eligible for direct pay, the answer would be yes, because we wanted to share those with you. And this is just a handy reference chart that you'll have in the slides to understand, if you want to get to those higher values, what the triggers would be for that. And with that, I think we have a polling question.
Awesome. Thanks, Craig. Then we have our second polling question of the day. I'd like to learn more about A, Section 45, production tax credits, B, Section 48, investment tax credits, C, Section 30C, alternative fuel vehicle refueling credits, D, Section 45W, qualified commercial clean vehicle credits, E, other credit opportunities, or F, I'm just here for the CPE. So if you select your answer and hit the submit button, your polling question will be recorded. We'll give you about 15 to 20 seconds here to answer this.
And Ben, I don't know what you've been seeing with the clients you've been speaking to, but I've been seeing a lot of interest in the Section 48 ITC and also Section 45W on the qualified commercial clean vehicle credits.
Yeah, I agree. Those are the areas where we're seeing the most interest. Quite honestly, in ways you do the math on an investment tax credit versus a production tax credit, if you just take a solar facility, for example, you generally need to have a fairly large solar facility in the neighborhood of multiple megawatts in order for it to really pay you back for the production tax credit to be effective in that situation. So that's a little bit of why I think we're seeing so much of the investment tax credits. If you're just putting rooftop solar on an administrative building or a health center or something along those lines, you're probably not going to have a large system where the production credit pays for itself over time, over that 10-year
Great,
period.
and we'll advance on to the results slide here.
Oh.
And there we are. We have a lot of interest actually in the production and investment tax credit. So that's great. So
that's great.
Yeah.
Yeah. And I just add to that, there is, when you're considering that and figuring out how it pencils out, doing the math up front to determine what's your ROI on 1 year with the ITC compared to looking at it over a 10-year period is, a worthwhile endeavor to make sure you're getting the best possible answer for your organization.
All right, I think we'll move on to tax credit enhancements now. So as Craig alluded to, each of the various credits have various enhancements that can be sort of added on to. We start at that 6% credit, and we can go all the way up to a 70% credit on investment tax credits. And this is what this slide basically shows, is how they sort of layer on top of one another. So we start there at that base credit amount, like we talked about. If we just take a solar facility is a classic example, and you got a $100 solar facility, you're going to start out with a $6 credit for placing that solar facility into service. And then the first multiplier and the most significant multiplier is the prevailing wage and apprenticeship requirement, which is a 5 times multiplier. And so you can quickly jump from a 6% credit to a 30% credit by either meeting prevailing wage and apprenticeship, which is essentially and if you're in the government contracting space, you've probably heard of Davis-Bacon wage requirements. It's essentially paying the prevailing wage and meeting various apprenticeship requirements for the construction of your project, maintenance of your project as well. And so for projects that are greater than 1 megawatt in size, you would need to meet the prevailing wage and apprenticeship requirements. If your project is less than 1 megawatt in size, you're actually exempt from prevailing wage and apprenticeship requirements. So that's an important exemption. And as you kind of think about it, as I was trying to figure out, well, what's 1 megawatt? What's that mean? What's that really relate to? How do I relate that? Generally, about if you're talking about solar panels, for example, a megawatt is generally 6 to 8 acres of solar panels. So you're looking at a fairly large size of a solar field in order to reach 1 megawatt in size or larger. So if you're just talking about rooftop solar, you're probably not getting there. If you're talking about putting solar on carports out in a large parking lot, you may get there. It's hard to tell. And so being at or under that 1 megawatt or less than that 1 megawatt is important, because maybe if you're sizing your system, it may not make sense, depending on your location, to be 1.1 megawatts in order to meet that, because then you have to meet the prevailing wage and apprenticeship requirements. As we move up the ladder here, and these are really designed to show that you stack these on top of one another. So if we move up, the next 10% adder is related to domestic content. This is your Buy America provisions. 100% of the steel and iron would have to come from the United States. And then 40% of your manufactured products, and it's initially 40%, it ratchets up to 55% in 2027, would need to come from the manufactured products would have to come from domestic sources. So if you're talking about solar, again, going back to that example, the steel or iron, that's the structural components of it, all would need to be made in the United States. And then the solar panels or the inverters, at least 40% initially, all the way up to 55% in 2027, would have to be manufactured in the United States. And then as we move, and we're going to talk about an important limitation on domestic content again as it relates to larger projects at the end of the presentation. But for projects over 1 megawatt and receiving direct pay, you do have to meet domestic content starting in 2025. And then the next 10% adder is being located in an energy community. You can receive this 10% adder in one of three ways. You can be located in a coal closure community or a census tract that has had a coal-fired power plant closure within a certain period of time, or an adjoining census tract to that. Or you can be located in an area that has traditionally had fossil fuel employment and is located in an area that's had a higher than average national average unemployment within that census tract or that metropolitan statistical area. That's the second way. And then the third way, and both of those first two, actually, the Department of Energy has a mapping tool that you can go out and just plug an address in and at least get a high level view as to whether or not you meet that requirement. You're located in an energy community. The next way you can meet the energy community requirements is related to the being located, what we call a brownfield requirement, or if you're located in a brownfield, a designated brownfield, or you've had a phase 1, depending on size, or a phase 2 environmental assessment done to determine whether or not there's a likelihood or the presence of environmental contaminations on your site. And then the last two are the two bonus credits that you actually do have to apply for. And so those are what are termed in the industry environmental justice allocation. There's a 10% adder for being located in a low-income community or located on tribal land. And then if the community benefit from your project actually goes to to a low-income community or is located on an affordable housing complex, you can actually get a 20% benefit. Now, as he indicated, you do have to apply for those adders, and in order to get them, the application period actually opened up October 19th. It's running for 30 days, the initial 30 days, so just a couple of more weeks left, or even less now, time flies. You have to make your initial application, and then applications received after that 30 days are on a rolling period thereafter. And each of those, if you meet the 30% adder for the base credit and prevailing wage and apprenticeship, but don't meet domestic content, you would then, but meet energy community, you get that 40%. So you don't have to meet all of them to get the 40%. You can kind of mix and match how you get to your increased enhancements.
Actually, Ben, there was a question that came in, and maybe we could get rolled into the next slide as well. But what type of documentation do you think is needed to meet PWA and or domestic content?
Yeah, so the prevailing wage and apprenticeship has had a lot more regulations issued around it from the IRS than has domestic content. And with respect to the prevailing wage and apprenticeship, there's a lot of entities that are familiar with government contracting already used to prevailing wage and apprenticeship or something very similar to it. The other part of it is that there's been a lot more, as I said, regulations announced related to that in terms of documenting that for the prevailing wage and apprenticeship, you have to show that all of your employees that are working on the facility meet the requirements. So receiving certified payrolls or some other way of documenting and demonstrating that you're meeting that requirement as you go along. And there is actually a good faith exception within the prevailing wage and apprenticeship guidelines that if you are testing it and you are meeting it in good faith, you don't have to pay as high a penalty. You can actually correct some of those penalties. You can actually pay a penalty if you miss it, for example, and go back and correct it and still keep your adder for prevailing wage. Domestic content is a little more difficult to talk about. I think you're seeing everything from certifications from your suppliers that you're meeting these requirements, and it boils down to how much you can dig into and understand where your supply is coming from. And I think there's going to be some additional regulations. There needs to be some additional regulations, I should say, as it relates to domestic content. But great question. It relates to that. So this slide that I've got here is showing the same thing for the production tax credit in terms of the adders that exist there. So you again, prevailing wage and apprenticeship. an increase for domestic content of essentially 10%, and the energy community adjuster as well. You'll notice that for the production tax credit, you don't have the environmental justice allocations that are associated with it. And then we wanted to provide you with some concrete examples. I like to see examples of things and understand, well, what's this really mean if we're actually doing something here? So if we take our first project up here on this list, we've got a rooftop solar facility that's being placed on an administrative building. It's smaller than 1 megawatt in size, so it's exempt from prevailing wage and apprenticeship requirements. But in our example here, it actually meets domestic content. So we've got $500,000 of qualified costs that go into it, and we pay $500,000 to put that solar facility on the administration building. The benefit that we can receive back, or the direct pay that we can receive back from the IRS after we file a return, is $200,000. So we've taken our $500,000 solar system and reduced the cost to us as the entity putting the solar system on down by $200,000. The next example would be a greater than 1 megawatt solar facility that has actually received the environmental justice adder as well. So this one is assuming you meet every adder that you could possibly meet, essentially going up to that 70% bonus. And you can see there that you got a 30% bonus for the prevailing wage, 10% for the domestic content, 10% for energy community, and then the environmental justice allocation of 20%. Your $2 million solar facility here, after the direct pay, you receive $1.4 million back in terms of direct pay. And then the next one is a larger microgrid, battery, storage, and interconnection. All of these things apply. And meeting just the prevailing wage, domestic content, energy community, that gets us to a 50% adder, or $10 million in direct pay or refund associated with that. And I think that, Craig, moves over to you.
Yeah, and when we put this presentation together, we wanted to talk about areas of the IRA that we thought would be meaningful and likely where those of you listening might be making investments. An investment tax credit or a production tax credit, those buckets encompass a lot. But when we talk to clients, we hear a lot about EVs, and we're going to talk about the commercial side of that. But we're also going to talk about essentially the refueling technology that you can use and receive direct pay on. And again, this credit, like a lot of the credits in the IRA, has been around for a while. But at the end of the day, because of the enhancements to the credit percentage, coupled with the fact that you can receive cash for them, that's why we're all here and why we're talking. So let's talk a little bit more about Section 30C and this credit. So the idea around this one is, and again, it goes back quite some time ago, is for qualified depreciable property, you could get 6% of the value of that. But in the particular case of under the IRA, you're able to get up to 30% of that. And you are capped at $100,000 per item of qualified property. So there is a level of strategy that we are working with clients in terms of how various things are grouped together. Different types of property are grouped together. If you were to think of a massive gas station right now, for anybody who's familiar with Texas, we've got a handful of those out there. It's pump after pump after pump. And what we're really talking about is a similar setup to that, but for EVs. And how you place that property in service, how you define one area of property or one item of qualified property compared to another is important so that you can maximize this value out. What you do have to take into consideration, though, is in order to get there, in order to make this worthwhile, you would have to meet the prevailing wage and apprenticeship requirement. That's how you're going to go from that 6% up to the 30%. And we have an example down here, as Ben said, we like the example. So the increase allows for a maximum credit to be earned based off of a smaller investment. So, for example, A $30 credit only requires $100 of investment at the 30%. But under the previous 6% rate, you would have to invest $500. So what we're really seeing with this is that by meeting the prevailing wage and the apprenticeship requirements, you're able to invest significantly less, but still achieve the same type of value for your organization. The other thing that is important to all of this, I'm going to sort of talk about the fact that this equipment needs to be placed in certain specific areas. Ben had talked about the mapping tool that's available for other things around energy communities and whatnot. But what's important about the refueling property is that it has to be within a specific census tract. So it needs to be located either in a low-income community or it's located outside of an urban area. And again, there are mapping tools that you can find on the internet in order to sort of spot check this yourself. It's something that Moss Adams frequently does for our clients. We get a list of locations and we're able to, very quickly determine whether or not you're located within or without of a census tract that would allow you to qualify for it. Sometimes there can be a difference between what is 123 Main Street versus 124 Main Street. And it will give you an opportunity to be strategic about where you want to place this property. Sort of as we have alluded to, for all of the investment tax credits, the property has to be depreciable. It has to originate with you as the taxpayer. And then the purpose of all of this is either that it's for the storage or dispensing of clean burning fuel, or it's recharging a motor vehicle that uses electricity for purposes of moving along. And I think that's what we're frequently seeing among EVs is that they're electrically driven with batteries. And so the right type of equipment located in the right census tract could conceivably mean, if you're going to be doing this anyways, a significant value for your organization. The other thing that we're seeing right now is people are considering options for the commercial clean vehicle fleet. This is sort of a bit of an inflection point, we feel, with the value that we'll talk about that is being offered under the IRA for cash back for clean commercial vehicles. We're at a point where we're seeing a lot of different taxpayers considering, is this the time to move from a carbon-based, gas-based type commercial vehicle? And they, vary in all sorts of sizes, from delivery trucks all the way up to massive trucks that you might see on the highway. And the question is, if we're going to do this, what types of incentives are available? And let's take a look at a couple of those. So the qualified commercial clean vehicle credit it's the lesser of two possible things. It's either 15% of the taxpayer's tax basis in the vehicle, and in the case of and what we're really also talking about is if we're talking about something that is not powered by gasoline or diesel, so we're talking about a clean technology, you could get up to 30%, or essentially the excess cost of the vehicle relative to a comparable vehicle that would use some type of carbon-based fuel. There are credit caps associated with this, however. The first cap is up to $7,500 for vehicles that weigh less than 14,000 pounds. And then commercial vehicles that are above the 14,000 pounds may be eligible for up to $40,000 in credit. I think for people that have looked at some of the larger commercial electric vehicles or clean vehicles, they're very expensive. And $40,000 is a significant reduction in those prices. They're still expensive afterwards, but being able to achieve up to a $40,000 savings is not insignificant. One proposition that we haven't talked about with great detail with the IRA is there's really no double dipping. So there's another credit that's out there, Section 30D, for clean vehicles. You can't get a Section 45 credit for commercial clean vehicles. and a Section 30D credit on the same property. They don't allow for that type of double dipping. So it's a consideration, but I would say if you're looking at a larger sized vehicle that's over 14,000 pounds, the significant value for you is going to be under 45W, not under 30D anyways. All right, so what does it mean to be a clean vehicle? So, and this is important. So the vehicle has to be made by a qualified manufacturer. The IRS has a web page for Section 30D. They're working on the 45W that will list who the qualified manufacturers would be. As you know, I think we can say fairly they would be who you would consider the usual suspects to be. However, it's just a question of getting them up on the web page. Again, the vehicle has to be acquired for use or by lease of the buyer and not for resale. There are some structuring choices, however, that buyers can make in terms of how they purchase these vehicles and whether they're for lease or not that are a consideration. The vehicle has to be considered clean. And while you can't double dip under Section 30D, which we were talking about on the other slide, that's essentially the baseline definition for all of this, or alternatively be considered mobile machinery. Mobile machinery is sort of its own animal, which is really interesting. We've worked with a number of clients that are essentially creating clean off-road vehicles. There's a lot of investment, interestingly enough, in clean lawnmowers that are used that then will be able to be qualified for the mobile machinery under 45W. It's a really interesting space right now. So as you're thinking about the types of property you might be buying, maybe forklifts, things of that nature, you might want to consider whether or not they would fall as a piece of mobile machinery for sale by a qualified manufacturer. That might then make you eligible for a credit that you hadn't necessarily considered before. And again, vehicles that weigh less than 14,000 pounds still have to have at least a 7 kilowatt hours of battery capacity. So that's an important consideration. But when that website is available and you're able to see the manufacturers that are qualified, they should also have a list of the types of vehicles that they're selling as clean commercial vehicles. And then again, for your larger size vehicles that are over 14,000 pounds, they have to have at least 15 kilowatt hours of battery capacity. And then lastly, the vehicle itself needs to be considered depreciable property, which again is, not an unreasonable requirement, and it's something that you should know up front for purposes of qualification. And I guess this gets us to another polling question.
Great. Thank you, Craig. And our third polling question for today is, my organization could use help with A, opportunities to green our fleet, B, opportunities to determine if we are eligible for EV refueling credits, or C, both A and B, or D, I'm just here for CPE. So it'll be about 20, 30 seconds here to answer this one. I'll turn it back over to you, Craig.
Craig, as we're waiting for people to respond to this, one of the questions that came in is, what are qualifying costs as it relates to an ITC, an investment tax credit? What qualifies and what doesn't qualify? Can you speak to that sort of broadly as to what would and wouldn't qualify?
So what we're looking for tangible personal property. It should have at least a 3-year depreciable life. It is so, and an important consideration in all of this is when it's placed in service. So you could buy that piece of qualified property, but until you actually place it in service, and you have to be the original user of it, it's not going to qualify. But say, for instance, you put something in the ground on November 8th of 2023. It meets the depreciable life. It's for a purpose that qualifies under the statute. It's a solar panel for the production of clean energy. you would be eligible to generate a credit on it depending upon the number of adders that you talked about in your slides, Ben, about, is it domestic content? Do you meet prevailing wage and whatnot? What's interesting about this, and I'll just give a little sneak peek, when we talk sort of about the four stages of the life of this in the later slides, when are you actually going to claim the credit for that? And what do we think the timeline post putting it on a return might look like? Because there's some really important open questions about that right now. Well, it would appear that we have some people very interested in CPE, which is great. And hopefully you will learn a great deal about this. But for those that are interested in, green fleets or EV refueling credits, this program has got a 10-year life cycle on it. And we anticipate if it's, ultimately the IRA is going to have the impact on America that the Biden administration and Congress wanted, that we're going to see additional growth in EV fleets and in, the EV refueling credits.
So, Craig, I think I'm taking this next piece here regarding claiming the credit. So we'll talk a little bit about how you claim the credit, or the process that is related to it. So this slide is meant to just be sort of a diagram. I'm not sure it's all linear, but at the same time, it is kind of meant to be that way a little bit. So the first part is just generating the credit, and you need to verify and validate your eligibility for the credit that you're trying to generate, the enhancements that exist as it relates to that credit, and then the project costs that go into that. So in general, it's the costs that are associated with installing that, if you're talking about an ITC, that equipment that is associated with the generation of that electricity. And then the project is placed in service. As you alluded to, Craig, it's very important as to when the project is actually placed in service. If it's placed in service in November of 2023, it can be a 2023 credit, depending on your calendar year as you tax year, as you move through things. The second piece is that the project needs to be registered. So you need to then register that project with the IRS. There's a portal that we think is going to open in the near future, that you will enter in various information that we know most of it. We know a lot of that information is related to the type of property, the credits that you're claiming, and other questions. And then out of that is designed to spit out a unique registration number that you're then going to take that registration number and file that on the tax return that is filed to claim that credit. And that has to be done prior to you filing the tax return. Otherwise, you can't put that registration number on your tax return. And the reason for this registration process is really to prevent fraud and abuse in the system, in order to ensure that each individual property that's registered kind of has that individual number and can be tied back. And then you're going to claim your credit. You're going to determine your tax year, and it's based on your accounting period. So if your accounting period ends June 30th, you're a June 30 taxpayer as it relates. Or if your accounting period ends at the end of the calendar year, you're a calendar year taxpayer. You then will claim that credit on a 990T if you're a tax-exempt entity or a tribe or a governmental entity. You're going to file a 990T, and it must be done timely. There is an automatic 6-month extension that you can automatically have granted, but what's important is there's no opportunity to amend or correct later. So if you miss it, you miss it, and that's unfortunate. And then you're going to wait, essentially, for that refund to come in. So the IRS has said that there's going to be that you will receive your cash payment after the due date of the return. So if you hurry up and file early, you're not going to receive it before the due date of your return. If you're a calendar year payer, your 990T is due in the middle of the middle of May, and it will be at least the middle of May or longer before you see that return. And then you can utilize that cash for future operations.
Ben, could we talk a little bit about the registration portal and some of the things that we've heard? I think there have been some articles recently and also some, discussions with some of the people that have been beta testing it. Maybe we could give the audience a little perspective on that.
Yeah, so we have heard that there have been some people that have been able to see this process and beta test it. I've talked to a couple of people that have been involved in that process, and so that the portal is being developed. There was just this last week, someone from the IRS said they expect it to be released in the near future. So it sounded like it was in its final stages of its beta testing and was going to be released here in the very near future. When that will be up to the IRS, and depend, I guess, if we have a government shutdown or something, if we're not able to fund the government past, November 17th. So I think some of that might impact all of that.
All right, we got our fourth polling question of the day. My organization could use help with A, verifying a credit, B, verifying credit enhancements, C, registering a project, D, claiming the credit, or E, I'm just here for CPE.
And, one of the things that we've seen recently with the IRS, and I'll analogize to another program probably some of our audience members may be familiar with, is the employee retention tax credit and the audits associated with that. And it gets me to the verification and the validation of, do you qualify for the credit, the tax credit bonus enhancements. The IRS is taking a very the word I would use is direct approach that taxpayers need to have their information available almost on demand for purposes of these credits. And I think one of the benefits of going through the registration process, given what we've seen as the requirements, would be taxpayers that put together the information around qualification and the different adders will be in a good position to address any potential IRS audits when they come through. We're seeing shortened timelines for responding to information requests.
And it looks like we've got, again, a lot of people here for the CPE, which is great. And if you've answered all four of your polling questions, you've answered all the questions. So that's great. So we'll move on and talk about some of the considerations that for direct pay that are specific to tax-exempt funding sources and other direct pay considerations. So to the extent that there is tax-exempt bond financing that is actually financing the solar facility, for example, that you're putting in, there is a reduction in that credit amount for that tax-exempt bond financing that might exist. So if that bond financing is specifically for that energy property, you do have to take that into consideration. One thing that actually was quite favorable is that grants and forgivable loans actually don't reduce the basis in your property. So the one caveat to that is you can't double dip, as you might suspect. So you can't claim more in credits and forgivable loans or grants than the original cost of the system. So an example of that is a less than 1 megawatt solar facility that costs $100,000, and it qualifies for that 30% credit. But 80% is paid from grant funding or some other forgivable loan. The max credit in that situation is $20,000 instead of $30,000. When we originally were looking at this, there was some thought that it may actually be that you would take the 30% credit on $20,000 instead of on the full $100,000. But the IRS did allow you to claim it on that full $100,000, just reduce it by the amount of that grant funding that exists. And the next thing, and this was a question that actually came up in the chat and wanted to talk about a little bit here, is that beginning in 2024, applicable entities, so if you're a tax-exempt entity or a tribe or an instrumentality of the state, you do have to meet domestic content percentages or requirements, or you actually will have a reduction in the credit percentage. And it starts at 90%, and ultimately, I think it's by 2027, it goes down to 0% if you don't meet domestic content and you're an applicable entity. And there is an exemption for projects that are under 1 megawatt in size. So it's not your smaller projects, but for those projects that are over 1 megawatt in size, and you are falling into this definition of an applicable entity, then you do have to meet the domestic content requirements starting in 2024, or your credit percentage is reduced. And then the last thing is that the IRS has made it clear that, and some other webinars and other things that I've listened to from the IRS, that partnerships are not applicable entities. So if you have two not-for-profit entities, for example, that are in partnership with one another, it's not an applicable entity and therefore not eligible for that direct pay requirement. With that, I'm trying to see if there's any other questions that we've left outstanding, Craig.
Yeah, you know what? While you're checking on that, I just think your last point about partnerships not being applicable entities, I think it goes to the fact that with some planning on the forefront, making sure you're in the right address zone for a number of the types of enhancements and credits we've talked about, coupled with, you know, just talking through what your plans may be beforehand, you potentially could avoid a pitfall or potentially really increase the benefit of the project that you were planning on doing anyways.
I'm not seeing any other questions come in. So I think, Chad, we can turn things over to you at this point.
Awesome. Thanks, Craig and Ben, for a great presentation today. And if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certification is available for download now in the CPE progress window. I'll keep the webcast open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.